Good afternoon, this is Mike Peterson, the Bear Market Investor with the market update for March 28, 2011. We're here looking at the S&P 500 stock index, and we're going to be looking at the Volatility Index after that. First, let's go and have a look at our monthly chart here on the S&P 500. Now, I'm showing you some of my original chart work here. This is something that you will not see anywhere else. And I hope that's one of the reasons that folks will keep coming back here to this YouTube channel and looking for new and fresh ideas on what the market is doing. And that's what I hope I'm bringing to you each and every time. Now let's go and have a look at this particular chart. I'm going to show you later why this is extremely relevant. Now, in order to define this chart, first I'd connected the bottom here in 97 to the bottoms here in 2002 and then again in March 2009. From there, I'd copy that exact slope into two places. I copied it here and I copied it here. Now you're looking at this chart and you realize that this is not the same slope as this is, and you are correct in your observation. That's because we are looking at this in arithmetic scaling. In logarithmic scaling, we can see that these two slopes right here are exactly identical. The differences, of course, between arithmetic and logarithmic scaling is that logarithmic scaling is percentage based. Arithmetic scaling is equal numeric based scaling. Now what we can see here is that the market did in fact pivot on this particular point in the past. It pivoted here, here, it pivoted here. We had a test of it there, and it repelled it successfully. But at that point, once we had gotten to this level here, which was slightly above that, I knew that the market was going to go higher. And so we did. What we're likely doing right now, and I'll explain this in more detail later, is that we are going up to challenge this. This also acted as support and resistance in the market right here, and we're looking at this again right now in arithmetic scaling. What we can see is that it provided resistance here and provided support here, then provided support and then again resistance before coming back down. If you were to turn this chart counterclockwise just slightly, you would see a head and shoulders topping pattern. In the case of the S&P 500 right here, what you are seeing is a double top. This is a classic double top pattern. The reason it cannot be a head and shoulders topping pattern is because it doesn't really fit the criteria. I was only noting that if you were to turn it slightly counterclockwise, that's exactly what you would have as soon as we come up to challenge this point. And I believe that's exactly where we're going. That also happens to be the exact point that crosses the 78.6% retracement right there that I've been speaking about also in the past. I think we're likely to go up and challenge those two places. And again, we're going to look at the Volatility Index later. I'm going to show you bigger perspective as well as a shorter term perspective on why I believe we're probably going to head higher. Now, I give that right now probably a 70-30 chance, in that there still is a 30% chance, maybe slightly less, but right around there, that we have in fact put a major top in on February 18. But the odds of that having happened had significantly reduced with this rally that we had. We had gone beyond levels that I would consider it likely for us to have continued tracing out a five-wave decline. I believe that we had the decline that we had from February 18 until the lows there looks like a three-wave pattern. And because I cannot really make it look very good like a 5-wave pattern, and because of the fact that we rallied so much, I am forced to conclude with the higher degree of probability that we are in fact moving higher. And based on this particular chart that I'm showing you, I do believe that's acting as a magnet right now, and that will draw the S&P 500 slightly higher. The rest of the indexes too are likely to move higher, particularly with the Dow Jones Industrials, because more or less that's tracking the same the same general feel as the S&P 500 in terms of price points. So let's go ahead and have a look at our shorter term charts, and I'll show you this breakdown in a little more detail. Okay, we're looking at the daily chart of the S&P 500 stock index, going all the way back to July of 2010. What I want to show you here is this is the low point after the April 2010 sell-off. From there, we had a very, very clear and well-defined leading diagonal. This is where we have wave overlap, as you can see right there, in that this fourth wave overlaps this first wave. Now, what is extremely important here is that leading diagonals can only occur in two positions. It can occur in a wave A, or it can occur in a first wave. In this particular case, this is a first wave leading diagonal. In that, we believe we're in an ABC correction from the March 2009 lows. And this point right here marked the bottom of wave B. And from there, we have been in a long wave C. Now, the most likely count here, if we are in fact to move higher, and I'll show you why shortly, I believe that's the case, is that this marks the top of wave 1 right here. We have wave 2. Then we have a elongated, or a wave 1 extension right here of 3. Wave 2 of 3. We had wave 3 of 3 conclude here, with wave 4 of 3 concluding here, which was that flat, that fourth wave flat that we were talking about, okay? Then we had our fifth wave into the February 18 peak. From there, I will show you here, it looks like we have had an A, B, or B triangle, C decline. In either case, we are overlapping this particular wave right here. Unless this were some sort of odd formation here of a leading diagonal, it is likely that we are moving higher, because in fact we have begun to overlap this, and I have not seen a compelling reason to believe that we had a 5-wave push here. Now, one could make an argument that this is wave 1 of 3 down, that we were having wave 2 of 3 up, and that we're going to have a very strong wave 3 of 3 down that begins very, very soon. However, the Dow Jones has crested that similar point right there, coming only within points of the peak that it had in the Dow Jones Industrials back in February. That suggests to me that the S&P 500 will likely go beyond this level as well. That suggests to me that this is not likely wave 2 of 3. So, what does this mean? It looks to me, and we'll examine this in closer detail, that we probably put in the top tick of wave 1 of 5 of C at today's 1319.74. And if this price territory right here happens to be the fourth wave of lesser degree, that we should proceed on lower into that 1284 area, which happens to be the low point of wave 4. If we do proceed on lower than that, I'm looking at this 1274 to 1275 area being a good area for that to stop in before proceeding on higher in a third wave, followed by a fourth wave correction. If we do have a deep retracement here of a first wave up, that we should see a sideways correction in the form of a flat or a triangle in wave 4 of 5 of C. And from there, I do expect that we will eventually push into this cyan trend line right here that I've shown you before, and that 78.6% retracement, possibly overshooting that slightly as we've done in the past. Moving up into that 1400 range, or the 80% retracement, which would be 4/5. Now, if we go beyond those levels, we have to be really, really darn sure that we're in fact in a bear market. Now, from a deflation standpoint, I do believe that the market will go lower. If you are an inflationist, you should believe that the market will go higher. The reason being, when markets are flooded with liquidity, liquidity always finds a home. Finds a home in the stock market, it finds a home in commodities, and it will continue to do so. So if you're one of the people that are hyperinflationists, you should not be looking for the stock market to tank. I think that would be highly unlikely. Germany actually saw, under hyperinflationary scenarios, the stock market skyrocket. Of course, they had a very dire outcome to that entire hyperinflationary scenario, but I don't believe that's what's happening here in the United States. In any case, I'm not going to get too deeply into the inflation-deflation argument, but know that, again, it is possible that we are moving higher. I am putting odds on that over the fact that we have already topped back on February 18, just because of this wave structure right here and what I've seen so far. Now let's go ahead and jump into the hourly time frame. Okay, hourly time frame. I want to show you this here, the indicators. We have the MACD rolling over here. The MACD histogram continuing to tick lower. We have the stochastic moving below the 50 level. We have the RSI attempting to challenge that level itself. But we do have the 200 period moving average in the hourly time frame that may act as some level of support right there. There are a number of different ways you can carve this up. One way is suggested that's more immediately bearish, and perhaps even more long-term bearish, is that this is in fact a double zigzag. Double zigzag would essentially look like this. That we had a wave A, B, C, we had an X wave, A, B, C. Problem is that we would have to reconcile this push lower right here in order for this to be a correction. There are other possibilities that I'm not going to get into right now with why this may look more like a three-wave push or a double zigzag. In any case, the way I'm thinking this could be is that this is either the top right here of a small third wave of probably wave 1 of 5 of C, or that this is the top of wave 1 of 5 of C. Okay, there are a number of different ways I can carve this out, and until we have further evidence to show us how we should do it, I'm just going to have to guess here. Okay, but there are a number of different ways. It just looks to be like if we're challenging this, that we're probably going to find some resistance come back down into this area of support right here. We're seeing these indicators roll over. Now let's go and have a look at the 15-minute time frame as well. Okay, 15-minute time frame. What you can see here is the indicators appear to be continuing to roll over here. The MACD below the zero line. The MACD histogram continuing to push back lower again, pushing past this prior low point here. The stochastic continuing to show strength in the downtrend in well and oversold territory at 585. The RSI showing weakness at 30.75. We want to continue to see that push down. Now you can see just in this 15-minute time frame just how difficult this is to count. I can find a lot of different ways of counting this. Okay, I can even count the decline from the February 18 peak as a 5-wave decline. It just doesn't look right. And with the other issues that I've shown you or talked about with regard to the Dow Jones Industrials pushing above that minor peak that we have not yet pushed above in the S&P 500, that helps me eliminate some likely possibilities here as well in the S&P 500. I just don't really have a good way of counting this right now. People that say this looks like a double zigzag or threes are perfectly right. It looks like threes. But I can also find a way of counting it into a 5-wave pattern as well. What if this is a 3 and what if the other's a 3? Well, there's a number of possibilities there too. If the decline from the February 18 peak until the low point is a 3 and this is a 3, there are possibilities with that as well that could lead the market higher or lower. Unfortunately, until we see further development here, we can't be sure. Now, this could be really the peak of a small third wave right here, in that we're in some sort of fourth wave, and won't see as deep of a retracement as I was talking about into that 1284 to 1275-ish area. But in any case, if that is going to proceed on higher, we probably won't see it proceed on much higher. Okay, I still think this is probably likely, wherever it ends here, going to be the top of a first wave of 5 of C. I don't think that's likely going to be something where we will show that it's actually the entire wave 5 of C once this completes, even if it pushes slightly above the prior peaks that we had on the S&P 500 on February 18. I just don't think that's going to look quite right, and I want to see that thing, if it's going to move higher, move up into that cyan trend line that I was talking about, that 78.6% retracement, possibly as high as the 1400 round number resistance, and around that 80% retracement on the decline that we had from the 2007 peak into the March 2009 lows. So there you go. I mean, we're just going to need more development here in the wave structure before I can give you anything better. But from a bullish scenario, it does look like, bullish meaning short-term scenario, it does look like we very well could push into that cyan trend line and the 78.6%. So be on guard with whatever happens, whatever short or long. You want to be careful here because the market is quite indecisive at this moment, and until we can see further development in the wave structure, there is no good way of counting anything at the moment and being sure of it. Okay, Volatility Index daily time frame. I did want to show you the weekly time frame, and I apologize, I just don't have time this evening to do that. This is, if you're new to me, original chart work of mine here that I've published, just like the original chart that I was showing you in the monthly time frame on the S&P 500. I don't believe you're going to see other technical analysts out there on YouTube or anywhere else that I've seen show you this chart. This chart was drawn with a Fibonacci fan here in blue of a longer term declining area of resistance in white, of a longer term ascending area of support in white, and then a long term horizontal level of support in green. This blue line exactly matching up with the white line is no coincidence. This is the 78.6% retracement on the Fibonacci fan. The only thing I drew was this right here. This is the 38.2%, 61.8%, and again, the 78.6%, exactly matching up with the longer-term declining area of resistance going all the way back to the 2008 stock market panic in through the April 2010 panic. From there, we had breakout attempts that failed. We had breakout attempts here, perhaps here, finally one that succeeded, back-tested, pushed onto that 38.2% retracement, failed breakout attempts, another attempt, back-test, pushed through it, back-test, waffled sideways, attempt at the 61.8%, got rejected off of that, came back down, waffled sideways a little bit, another rejected attempt, just short term anyways, came back down to the horizontal level of support, successful breakthrough of the 61.8% on the Fibonacci fan, back test, perhaps another back test right there, waffled sideways a little bit, breakout in volatility, unsuccessful breakout. This is what I was worried might happen here, okay? We could still see, if we have in fact topped on February 18, this actually successfully break in the short term with another thrust to the upside. However, I'm not so certain of that at the moment. As I've noted, I put maybe a 70-30 probability on us continuing higher in the S&P 500 versus the bear market, larger bear market having resumed. Okay, in the volatility index, we would probably not see the break of the 78.6% retracement in the declining area of resistance in the volatility index, perhaps for 2, 3, 4 months. Okay, hopefully it comes within a month or 2 months or something like that, maybe into May or June. Hopefully it doesn't last into July or even August. But I want to note that it could actually last that long. In other words, we could have the market, even if it continued to find support at this area, continue to eke out every last moment of time until it had nowhere else to go. Or we could break below this long-term area of horizontal support right here. Okay, so there are a number of possibilities. However, I do think this is probably going to hold, because I think if it didn't, I think if we continued to waffle sideways for a while and then this did break to the downside, the market would probably be higher than that 78.6% retracement in the S&P 500, or even the 1400 round number resistance in the S&P 500. So, number of different possibilities here, but I did want to show you this is exactly what I was talking about. We've seen this in the past where we had the false breakouts, okay, and only to come back down and eventually break through. That may be exactly what's happening here. So I'm going to keep all of my trend lines here exactly the same. We want to see a successful breakout of the 78.6% retracement on the Fibonacci fan in the declining area of resistance here. Once we see that, I am going to be very confident that the larger bear market has in fact resumed. Have a great night. Please rate the video if you would. I would appreciate it. If you have not already done so, please do join the YouTube channel and subscribe to it. I would really appreciate it. It's nice to see that people are following and appreciate the videos and work that I'm presenting to you. Have a great night.